So we'll start with purchases, okay? So if you're purchasing a home, the first thing we look at is there is a grid of loan level price adjustments that's purely based on your FICO score and the loan to value. So how much you're putting down and what is your credit score. So the lowest it could be is 0. So you might have 0 loan level price adjustment, and you fall into that category if you're putting at least 25% down or more, and you have a 780 or more, 780 or higher FICO score. So perfect credit, 25% down, no LLPA. The only, if you're putting 40% down, pretty much regardless of your credit score, there's no LLPA if you're putting 40% down until you get under a 640 FICO score. Now, keep in mind, these are Fannie Mae and Freddie Mac conforming loans, totally different math when we look at FHA, VA, or USDA. But which are not the majority of the market in most areas. The majority of loans are going conventional, conforming loans, Fannie, Freddie. So those are really the only scenarios. So over 780 with 25% down, or pretty much any credit score with 40% down. Otherwise, you're paying some sort of adjustment to the interest rate because of your down payment and credit score. Let's look at the average home buyer. So let's just say that someone is at a 700 to 719 credit score and they're putting 10% down. That's going to be 1 3/8 additional cost. So just think like 1 3/8 discount points more that you have to pay because you're putting 10% down with a 719, under 720 FICO score. But even someone with a 739 FICO score putting 10% down is paying 7/8 of a point, so almost 1% more. So on a $500,000 house, 1 point is an extra $5,000. So they're just under that. Even with 10% down and a 739 FICO. So that's the light version. Now, where it gets a little bit crazy is when we look at investment homes, second homes, and cash out refinances. So I'm going to go into those numbers, and that's really the area that Barry has said needs the most attention. And clearly you're going to see that when I show you these numbers or talk to you about these numbers. And I'm sure my team can put a graphic up on the screen to show you these LLPAs from Fannie Mae. You can also just go to just Google Fannie Mae LLPA matrix, and you'll see this. It's pretty self-explanatory. So in addition to your loan to value and your credit score, you also then have these additional attributes, right? Things like, is it an adjustable rate mortgage? Is it a condo? Is it an investment property, a second home, a manufactured home? Is it a high balance loan? That's a loan between the conforming limit and jumbo, kind of that space in between. A high balance loan, for instance, is a 100 basis point adjustment. It's a full point. These are typically $800,000-$900,000 loans. So we're talking about an $8,000-$9,000 adjustment in the price, even as low as 20% down on a high balance. Now, if it's a high balance adjustable rate mortgage, it's 2.5%. Now, if you know anything about adjustable rate mortgages, you know that there's very little premium pricing available on those. And so, there's very little premium pricing available on any loans, meaning you can't really just raise the interest rate to absorb this cost. But on ARMs, it's even worse. And so you're having to pay 2.5 points more for an adjustable rate loan if it's high balance. It just basically makes that product, you just wouldn't do that product. Let's just put it that way. And that's the point here I'm trying to make, is some of this stuff is just so egregious.